Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Brian Stutland, Managing Partner, Equity Armor Investments, as well as my co-CNBC contributor and YieldMax strategist at YieldMax ETFs. We're here to discuss the Federal Reserve's Jackson Hole statement and its immediate impact on market volatility and inflation expectations. It's great to have the both of you with us, Brian. Let's kick this off with you. It's been a mixed bag of recent economic data, whether you're looking at jobs or the stubborn inflation that we're dealing with. We're waiting to see what the next move is going to be. What's the statement telling us with the Fed stance on inflation, and how is it impacting volatility right now?
Yeah, I think what we've seen from Powell today basically is that they are going to be willing to likely cut interest rates come September at the next meeting. And basically he was stating that the unemployment picture, when you look back at some of the revised numbers and what we actually got in the last report, that the job market is starting to decay a little bit. And so there is some concern for that and reason to give a rate cut coming up. Now, you mentioned, the other flip side here is inflation, which those numbers have not been below their 2% target rate in their dual mandate. So it has been a slippery slope for them to deal with, but it does look like we actually are going to get this interest rate cut. The market responded really well to that. Obviously, market's up over 1%, depending on what index you're looking at. And so certainly the market likes what they're hearing there. The one thing I would just say is volatility, the VIX collapsing today below 15 now in the VIX, to me indicates it's kind of weird. It's been rare that I see a rate cut come when you see volatility as low as it's been right now, the VIX being below 15, and then they have to cut interest rates. So there does seem there's some sort of liquidity in the market. I guess there's some concern over the labor markets, but it looks like we're going to get that rate cut, and the stock market likes it.
Yeah. Mike, I think part of the challenges for the Fed, it's not simply just about employment and inflation. A lot of what we're seeing as it relates to those two data points is it's policy influenced. And that's not typical of what the Fed normally deals with. So I think that's a challenge that's unique to this particular cycle. What do you think the impact of rate of change is going to be? And what does that mean for price stability and what the consumer is capable of handling?
Yeah, well, first of all, rate of change and the anticipated range of rate of change. Now, this is we're really getting into a really narrow slice of how they might derive policy here. So what do I mean by anticipated rate of change? So what I'm referring to here is, when inflation is a rate of change. If you say you have a 4% inflation rate, that's suggesting that on an annualized basis, prices are increasing by 4% per year. Tariff impacts could be a step function, meaning that rather than introducing a continuous rate of change, you get an increase in prices. That increase has to bleed its way through the system, but once it's in place, it doesn't necessarily continue in perpetuity. And I'm wondering whether there's a possibility that that is how the Fed is interpreting the inflationary impact of tariffs as they go into effect here. And I think that might also help explain what we're seeing in volatility and what we're seeing in the equity markets, because to Brian's point, the market is behaving like this is a Goldilocks moment. It's like everything, somehow this is good news and more good news. That's how the market is reading it.
I don't know, Mike. When you have a new Fed chair that comes in, can he or she tolerate inflation for the sake of other economic goals? And there is a long-term risk to that approach.
Well, I don't think that's exactly my point. I think that that Powell, for example, he does not want to be basically put on the wall right next to Arthur Burns, right? So he would not take that approach if he thought that it was going to create long-term inflation. The question is whether or not short-term inflation readings are not indicative of what you're going to be experiencing 12 months from now. And so that is the legacy he's going to be leaving his successor. I think we need to be very clear about that. So I think this has to do with how he is interpreting the data and how other members of the FOMC are interpreting the data. I don't think that they're simply going to pivot and suddenly just, create another early 1970s Federal Reserve that's kowtowing to the administration, for example.
Right. So, Brian, the question is, what do markets do in between now and the September meeting?
Well, I mean, when you look at the behavior today, it looks like markets can go higher. It looks like, yes, we hit that like 6,500 level in the S&P. And they kind of backed off there throughout the month of August. We still have this seasonality trade, right, where people kind of get a little fearful come September. We're sort of in this period where we have to now wait for the Fed to actually cut rates. We don't really get any more earnings news out, so to speak. So that sort of weighs as a headwind to the market. But it does look like the market wants to move higher. It does look like what Mike's been talking about here, this inflation is maybe just a one-time blip. It's like the earnings report where a company has to take a one-time charge, but then after that, their earnings will continue to grow. So if the economy sort of kind of becomes stagnant on the unemployment front, now the interest rate cut makes sense. Now the market can go higher, valuations can probably go higher. So, I would still, lean on the bullish side of things right now.
Now, Mike, let's switch gears and talk about the crypto market for a moment. Certainly, Bitcoin's experienced some short-term volatility up to 125 and back down. What do you think is behind the volatility that we've seen here? Is this a potential top? Are you expecting a reversal?
No, I don't think it's a top. I mean, it would be kind of it would be a little bit strange, I think, for me, somebody who's been very vocally bullish in the crypto space and in Bitcoin specifically for 3 straight years, to suddenly say, well, because we hit these new highs and gave a little bit back, which, by the way, is a normal sort of healthy market action for almost any risk asset, right? That this necessarily means that we're going to see a huge pullback. Is a pullback possible? Sure. I mean, this is a more volatile asset than equities typically are, and certainly more than fixed income is. So you take a look at that and say, okay, well, could we have a setback? Yes. Do I think this disrupts the long-term story? No. I think there's also been some significant repositioning, right? So, we saw a lot of people saying, Bitcoin is the reserve treasury asset in the crypto space. And then the next thing you know, everybody's saying, but let's not forget about Ethereum because it's critical in stable coins. So when you start putting those two things together, you're going to see money flows, right? And then, of course, let's not forget, we also saw, some whale transactions take place in Bitcoin as well, and also in MicroStrategy. We saw a filing there where there's a big sale from an insider. I think those things put together help explain the price action.
Right. I mean, of course, in the space is broadening out as well. We're starting to understand the different use cases for Bitcoin, and then, the infrastructure sort of plays like a Solana as an example, or in Ethereum, to your point, Brian. So the question is, do you buy the dip? Do you take profits? Do you continue to hold? I think the question is, what kind of trader or investor, how are you thinking about your position?
Yeah, I mean, we took this opportunity on the dip to buy it for clients, actually. And to Mike's point, actually, I do like the two split forms of crypto, Bitcoin on one side and Ethereum on the other for the stablecoin play. We actually did about a 50-50 allocation to that if we were going to make an allocation to crypto. I mean, I'm not making a whole portfolio worth of crypto here, but certainly there's a place for it, call it 5 or 10% in someone's portfolio. And this little pullback I thought was a bit of an opportunity to buy. Like, Mike mentioned there's been some selling that's gone on, and obviously that's going to, again, provide some headwind or some headwind to, the price action moving back higher. But I like it. I mean, we saw it move up today after the Federal Reserve, after Powell spoke. So trading above 115 sort of on Bitcoin here. I think it can get back up to 120 pretty quickly. Then you might see some sellers come back in, that basically sold or got in too quickly around that 120, 125 level. So that might be a little bit of a headwind there, but certainly I thought the pullback was a nice buying opportunity here, and I think there's still upside to go.
So, Brian, moving on to our next asset class, let's talk about bonds here for a moment, specifically the MOVE Index MOVE, which is basically the VIX for bonds, anticipating volatility of treasury bonds moving forward. It's hovering near its lowest level since early 2022. So what does that tell us about the bond market's expectations?
Yeah, to me, it seems like we're just going to be kind of stuck in the mud with interest rate levels here. So we might get this quarter point cut coming up in September. We might get one more at the end of the year or early next year when maybe they wait and see when a new Fed chairman comes in what they want to do. But it certainly seems like we're going to be kind of stuck in the mud here on interest rate levels where the 10-year kind of trades slightly above 4%. Short-term T-bills trade below, looking to trade below 4%. And we kind of sit around here. That's what the MOVE Index is basically showing, that we're not going to get a lot of volatility. Now, that's actually a pretty good thing, I think, for stocks in terms of a ripple effect. We always talk about volatility in one place in the pool. When you drop that bowling ball and you get that ripple effect waves throughout the pool, it gets felt everywhere. And if there's not a lot of volatility in the bond market, there's probably not going to be a ton of volatility in the equity market. So maybe that's a good thing.
So, Mike, if there's an expectation that rates are going to kind of be stuck here for a while, what's the relationship between interest rates and stock valuations?
Well, I guess it depends a little bit on whether we're thinking about the short-term rates or the 10-year and beyond. I like to think about the 10-year as kind of the anchor on rates when we think about where should corporate earnings yields be? So that's the inverse of price to earnings. Where should we expect mortgage rates to be, and how's that going to impact the housing market? I mean, if you think about it, 10-year rates right now are about where they were in 1962. They're about where they were in 2002. If people are level setting that part of the curve based on what happened in the post-GFC era, I think that's a misguided effort. The 10-year rate is actually, I think, very reasonable. If someone said to me, look, we're going to see 10-year rates hover between, call it 380 and 480 over the course of the next 15 years, I would say that's indicative of a fairly healthy circumstance. I would actually be happy to hear that. And I think that would generally be thought of as a positive. I think it's disruptive for housing because you have a lot of people who are locked in at rates that can't be replicated with the 10-year at 4.25 or something like that.
Yeah, but when you think about stocks and interest rates relative to valuation, don't fundamentals mean more at that point, especially when you're thinking about earnings and what companies are able to deliver?
Well, I mean, let's think about it. If the curve is, if it starts to steepen a little bit, and we have reasonable borrowing costs and we have decent GDP growth, that is a pretty good set of circumstances. And so from my perspective, I look at that pretty favorably. I don't know how Brian feels about that, but if somebody said to me, gee, we're expecting the 10-year to go down to 3 or below, I would say that's worrisome, because what that tells you is that the bond market's really not optimistic about economic growth. We clearly don't want that. So we want to see 3% GDP growth. We want to see 5 to 6%, top line growth for the S&P, and, maybe 8% adjusted EPS growth. You get that. That's a pretty good situation.
All right, Brian, let's get your final thoughts.
Yeah, I think look, if you have interest rates that are kind of stabilized, like Mike said, like the 10-year sitting between 3.8 and 4.8, basically, now corporate planning, you can plan ahead for what you need to borrow at, what you need to make your widget, so to speak. And to me, that means valuations can go higher, because I think people then have clarity where the economy is going. And then you get GDP growth behind that, you get price stability, and that allows multiples to expand to the upside. And I think that's a very bullish case. If you look at the MOVE index and the volatility of bonds, when that becomes very low, it's very good for stocks. You don't necessarily need low interest rates to have higher valuations. You need bond price stability and liquidity in the market for valuations to go higher. So that makes me pretty bullish on the market.
All right. Appreciate your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.